Good morning. Goldman Sachs warns that a disruption to the shipping through the Strait of Hormuz is so severe that oil markets may soon be forced towards $100 a barrel, simply to ration demand and stabilize a global energy system suddenly short millions of barrels a day. That was yesterday before the markets opened. Today we're above $100. Hartnett argues that the 2020s may be replaying the 1970s playbook: geopolitical realignment, fiscal expansion, and currency debasement, fueling an inflationary boom that lifts markets early in the decade, but risks eventually ending the same way the 70s did, with tightening policy and the return of stagflation and higher gold prices. Before we do the markets, a little housekeeping. I, for those of you following along, I did finish that book. The book is on collateral and gold, and the future of collateral in the world is going to be gold based. And the editor has it now, so I've sent 3 chapters of that out to the founders. This weekend was my birthday, and a couple founders took me out for dinner. Thank you very much. I'm thanking them for that, and I'm thanking them for the gold pen. I appreciate that. And we have a lot of content to go over. So let's do that. 10-year yields are up 4 at 417.70. Yield curve controls in our future. The dollar is up 42 at 99.26. The SP 500 is 66.65, down 69. NASDAQ, conversely, is 24,363, up 175. The VIX is 32, up 260. Gold is 5,084, down 87. Seems surprising. Not that surprising when you think about the initial reaction. Silver, 83.27, down a buck 20. Copper is down 7.75 cents. WTI is up, I'm sorry, up $12. I almost sit down. Up $12 at $103.52. Natural gas similarly up 17 cents at 354. Platinum down 35. Palladium down 28. Gold and silver down 12. Bitcoin up 1,500, basically unchanged over the weekend. And grains are all up. Okay, if you're looking at the board and you're saying, why is gold down? Everything else is if oil is up, because the every commodity market is now looking at stagflation, not the war. So silver is down, it's industrial. Okay, copper is down, it's industrial, and you're going to see anything that we can do without, that we can live without commodity wise, is going to get sold first, because we're going to hit a level in the price of oil and it's going to be demand destruction. You're not going to stop eating. You're not going to stop making fertilizer, but you are going to stop making solar panels. You are going to stop making copper wire. So the whole economy starts getting triaged. And that explains why silver and that explains why copper are down. Gold, I don't think that explains why gold is down. I think gold is down and it's probably an opportunity. I'm not telling you to go out and buy it, but I am saying that the biggest players in the gold market are the macro discretionary funds. And right now they're all in oil, and they're all taking their money out of gold and putting it into oil, because the money they lost in gold, $80, that's nothing compared to the money they're making in oil right now. So I would say, on the whole, the thing that doesn't make sense here is gold down $89, which in normal circumstances, I would say that would just be a buy. I would just go in and buy it. Now, I'm not buying it today. I am buying miners, however. We know we talked about the miners as well. So let's talk about the rest of the front page there. So front center, oil hits 120. That's Brent. Lower right-hand side, any other day, this would be the normal, this would be the leading story. Silver whale, the China silver short breakdown. We got the timeline of that from Stock Shaman, and we broke it down and we put some other information in there that wasn't exactly easy to get. And the lower left-hand side, we have the mining share discussion with founders. Okay, let's get to the main stories. Brent hits 120, chaos replaces Pax Americana. Goldman Sachs trading desk argues on Sunday before the open that the oil market is underestimating the severity of the current supply disruption tied to the Strait of Hormuz. With flows reportedly down sharply and tanker traffic constrained, the physical energy system is tightening rapidly, making $100 oil increasingly plausible as markets move toward demand destruction to restore balance. Turns out they were right. Reason we say Pax Americana is because we have an insight that no one else has been talking about yet, and they probably won't for a while. But When you look at the price of oil average during wars, that's a bad thing to do. You should look at them before and after the Iraqi war. Before the Iraqi war, the first Iraqi war, oil would scream. And after the first Iraqi war, when we made ourselves present in the Middle East, Pax Americana, oil was muted in its response whenever there was a war. This is the first time oil has responded like there is no Pax Americana. And when you think about it, there is no Pax Americana. We're creating the chaos for whatever reason, right or wrong. We're creating it. And so the unsettledness in the Middle East is going to be exacerbated by us, especially if it cuts off oil to strategic partners of Iran like China. We're at war with China right now. So that's that story there. We would say that's must read because that's insights from traders from around the bank, and they've been spot on with oil for the last month. Second story is this report reframes, well, this is Hartnett, right? Hartnett frames, he argues the 2020s may be replaying the 1970s playbook, as I mentioned. Geopolitical realignment, fiscal expansion, and currency debasement ignite an inflationary boom that initially lifts equities and commodities. As in the 70s, policy tolerance for inflation sustains growth early, but unresolved price pressures risk later stagflation and policy tightening. Simply put, Hartnett has been hinting at this for a while, and we've been hinting at it a little bit more heavily handed. And that is that the 2020s are the 1970s in the sense that we need to change the engine of the economy from services to manufacturing. Back then, we had to go from manufacturing to services. And that entails that enlists that needs easy monetary policy and fiscal spending to retool the economy. And when that happens, you're going to get some inflation with the economy being retooled. If it's successful, the economy retools, we're in manufacturing, and inflation abates. If it's not successful, inflation doesn't abate. They've run out of patience for retooling the economy. The fiscal side drops and gold goes up as the stagflationary economy kicks in. So the question is, if you're a student of the 1970s, as I happen to be, is this 1973 or is this 1976? In 1973, we were just getting going. We just decoupled from the gold standard, 1971. And as horrible as that was, the first 3 years after that were a boom because we just spent money. We didn't have to care about the gold standard anymore. That was the kids out of play school, kids out of school for the summer. And then 76 came, we had the 1976, the bicentennial, and then boom, it was over. So the question is, are we in 1973 in the middle of the boom, or are we at 1976 at the end of the boom? And stagflation is the missing link for that boom versus bust. And high oil prices are the missing link. So I would argue we just moved the doomsday clock closer to 1976 than we have been at 1973. Moving on. We have plenty of stories over the weekend. China's PBOC buys gold 16 months running at prices above 5,000. That's significant. They're buying with prices above 5,000. I mean, that's where the price is now. I say that sarcastically or pointedly because that's what you should be thinking about miners. That's the price of gold now. Special silver squeeze roadmap. RBC put out a piece over the week, last week, that we wrote up. It's a silver squeeze roadmap. Now, it's a very clickbait headline, and it is about silver squeeze. Don't get me wrong, but they actually put both sides of it. They weigh it evenly. You know, this is why silver is going to go up, and this is what would happen to prevent that if it were to happen at all. Silver whale, we mentioned that, and that's pretty much it. You see the rest of them there.